Okay, let's get started. Good morning, everyone. Welcome to West Texas A&M University. This seminar dealing with the global financial crisis. Very important, very relevant, very timely. The first part of this seminar took place last October when the crisis started. And at that time, when we were done with the seminar, some of the audience members from Amarillo as well as from WT, they asked us, can you do that after 6 months? Because all the actors will be changing, all the environments will be changing, so this is how we are revisiting. We are very proud to have the same speakers, and that's what each speaker will take about 15 minutes, and we will revisit all those things. And global financial crisis, very big event, very big problem, very big issue. And it's still on the radar screen. It hasn't gone anywhere. And let me share with you a few books, because our job as a higher education institution is also to help you understand what are the issues behind this whole thing. When I went to school, and some of you, my colleagues, went to school, we read this book, Manias, Panics, and Crashes. Very famous book, Charles Kindleberger, who passed away some years ago, and he wrote this book. This is 5th edition, and it's still being used heavily in academia. This book just came out a few months ago. Professor Ferguson, Niall Ferguson, is from England. He wrote this book, The Ascent of Money, and it's one of the best sellers on New York Times. I strongly encourage you to read. It talks about the history, why crashes happen, why problems happen. Very nice book. Mr. Ferguson now teaches at Harvard. Muhammad Al-Arya wrote a book, came out some months ago, and it says When Market Collides. Muhammad Al-Arya used to be the CEO of Harvard Endowment. Now he's the co-CEO of one of the very big bond companies. Very interesting book. This one is by a person by the name of Nassim Nicholas. He went to France, Paris University, got his PhD in operations management, and he talks about the black swan. Black swan is all the unexpected events which happen in the world. Global financial crisis is also one of the most unexpected events we witnessed in the last 6 months. And this book is also one of the best sellers. The last book I have here is Fixing Global Finance, and it's written by Martin Wolf, who's the #2 associate editor of Financial Times. So just to help you understand the crisis, you need to understand theory, you need to understand why things are happening in a way. I will share with you very briefly one piece of data. According to Asian Development Bank, they said that in the last 8 months, $50 trillion has disappeared. In terms of value, in terms of intangibles, $50 trillion is a lot of money. So the question is, do you think that we can blame our textbooks? Maybe we did not teach you, all these things. Do you think we can blame Mr. Greenspan? I was attending a seminar at the Dallas Fed 6 months ago, and this thing was issued very heavily, although Dallas Fed was very careful. They did not want to include Mr. Greenspan, but we know that there is some blame. Did we get carried away? Is it because of GM or the auto industry? Can we blame China or the United States dollar? Can we blame our consumers? Maybe we got carried away. Maybe we spent too much. Maybe we used too many credit cards. Okay, so there are so many answers, and the amazing thing is that at the end of the day, you don't have a quick fix, you don't have just one answer. Markets are global, we are witnessing globalization, the crisis is truly global, and so these are all the things we are looking at. According to World Trade Organization, in the next 9 months, the world trade will be 9% less. So this is a very big news. A very big issue, and G20 just met last week, and they allocated $1 trillion. Possibly $2 trillion are already being allocated, and we are 16 months into recession according to yesterday's New York Times, and that's a very interesting story, that the economy is operating at 7% below its potential. 14 trillion to we will come back to 13 trillion, maybe. 24 million people are affected. US will be but the first country to recover from this crisis, and it has been discussed by many people. United States will be the first country. They got into this mess first time, and they will also get out first, okay? There is more international coordination needed. Crisis is global, all these things. So many questions, so many answers. But at this time, I would like to invite our first speaker, and I will let him introduce himself, Mr. Robert Juba, Vice President of Merrill Lynch, and he will talk about some of the issues. Let's give a warm welcome to our friend.
Thank you, Dr. Anwar, and thank you all for coming. It's kind of a daunting task to want to come here about the economy, because we know, by all measures, those that were mentioned and those that you've heard in the media, the economy's not great. But I guess bad news sells, so here we have a full room. By way of introduction, I'll just very briefly give a little background. I have been with Merrill Lynch since May of 1999. Prior to that, I spent 5 years working for the Amarillo Economic Development Corporation. I did kind of a mix of business recruitment and I guess you can call it lobbying, but it wasn't technically lobbying on behalf of the Pantex plant. And before that, I worked for the city of Amarillo. I went to graduate school at Texas Tech and undergraduate at University of Texas. So there's the briefest of thumbnails of my background. My 10 years with Merrill Lynch have been pretty tumultuous. We've gone through 3 CEOs. Now my MER stock is BAC stock, and it's quite a bit smaller. It's missing a 0 on the end of it that it used to have. But markets have also been tumultuous, and for 10 years now, investors have lost money in stocks. Treasuries have been the best asset class. Treasuries and gold have been the best asset class over the last 10 years. So we want to kind of recap not only where we were 6 months ago, but where we are now. First, I'll start with good news. I think the worst of the financial panic part of the crisis is behind us. I think we saw that. Really, we were right in the midst of it the last time this group gathered. But bad news is we're still mired in the worst recession since World War II. And recessions are deflationary in nature. That's just the nature of recessions. Dr. Anwar talked about $50 trillion in wealth that's gone away around the world. That represents deflation. 20 trillion of that has been the U.S. household. So between home equity, 401k declines, stock declines, corporate bond declines in value, I think art collections, I think everything except guns. Guns go up in value, and gold has too. So other than that, everything that you own, whether it's oil and gas leases, commercial real estate, it's all worth less than it used to be, and that is the essence of deflation. Now that deflation is being countered by the most vigorous reflationary effort that our government's ever gone on. So I think this whole year, for the balance of the year and really into next year, is going to be a tug of war between those very strong deflationary pressures and the reflationary or inflationary impact of the government's actions in the Federal Reserve. So with the tug of war theme in mind, I'll just go through some data. As I mentioned, I think the worst of the financial panic is behind us. We've seen some stabilization in credit markets. There's been a positive impact of the TARP money, the AIG bailout, mergers of some banks, increase in FDIC deposit insurance, I think has been huge. So we've seen stabilization. People aren't panicking as much about, is their money safe? But credit spreads are not back to normal. So there's still a sign of significant stress in the system. We're not back to where we were in 2005 or 1995 or 1985 in terms of normalcy of the difference between corporate credits and treasuries. The newly announced, what's now called the PPIP program, which is kind of the successor to TARP. PPIP is Public-Private Investment Partnership. That's designed to buy bad assets for the federal government to kind of put up some money and private sector put up some money and the FDIC to put up a lot of money and buy bad troubled assets from banks. This was originally Secretary Paulson's plan back in when we met last. It was never really implemented. TARP became a way to inject capital into banks, and so now they're going to try again. So you can call it PPIP or TARP 2.0, whichever you want to like. But those are helping to return some things to normalcy. So I think the worst of the financial crisis is behind us, as I said, here in the United States. I'm not convinced that in Europe they've really faced their demons. Europe has been affected negatively by our credit crisis and the decline in the value of our mortgage-backed securities. They also are much more leveraged. The European banking model is much more leveraged than the United States model. They have always had a combined investment banking and commercial banking model, and their leverage ratios last year averaged more than 35 to 1. Some banks, including Barclays, were leveraged 60 to 1. So that's the kind of leverage that got Fannie and Freddie in the United States, got Fannie Mae and Freddie Mac completely insolvent, and yet some of the biggest banks in the world have those high leverage ratios. They have trimmed those back some, but the situation in Europe, the reason I worry about that is that if you think about the euro, which is only 10 years old, the promise of the euro was that people all over Europe could borrow at the German borrowing rate, which was always less than the rest of continental Europe. And they discovered that rates were low, and the euro became a strong currency, and so strong, in fact, that in Eastern Europe, where they wanted to live what I'll call the American dream and have home ownership as they threw off the shackles of communism, they had a housing boom in Eastern Europe, and a lot of that lending was done in euros or Swiss francs. But those people who live in Hungary and the Czech Republic, Slovakia, Poland, the Baltics, have seen their local currencies decline in value by 50%, 40 to 60%, depending on the country. So if you're being paid in zlotys in Poland and you were having to pay back in euros, and all of a sudden your zlotys were worth half of what they used to be, even if you didn't have an adjustable rate mortgage, your mortgage payment just effectively doubled. So they're seeing waves of default in Europe. So that's a huge issue. The Austrian banks have appealed to the German banks for help, and that's why I think the ongoing global financial crisis is not over. I don't think they've really faced that there. So in the United States, the good news, following the good news, I think we've seen the worst of the financial aspect of the crisis, and there's a few signs of life in the economy. February had a few good numbers. The housing numbers picked up a little bit. Durable goods orders were up just slightly. I would have one warning sign on that: the seasonal adjustments. Whenever these government statistics come out, they are seasonally adjusted, and the seasonal adjustments were for February were the most aggressive since 1982. Now they'll come later and try to tell us why they had such significant seasonal adjustments, but just kind of take that with a grain of salt. And the jobs data in the U.S. still looks pretty rough. We feel like unemployment may reach 10% by the end of the year. We're very blessed in Amarillo to have a much, much lower unemployment rate. Thankful for that. If you're seniors, be very thankful for that. But it's still rising throughout the country. And that's a lagging indicator. It's not a leading indicator, but personal income tends to be a leading indicator, and it's hard to see a good increase in personal income while unemployment is still accelerating to the downside. So we need to see the employment rate stabilize. It doesn't have to start coming down, because like I said, it's a lagging indicator, but you'd like to see rising personal income. The credit contraction continues, and I think this is a secular trend. This is not, in other words, it's a long-term trend. It's not just overnight. It's not just a 6-month trend. There was what was called a shadow banking system, where a lot of your student loans, credit card loans, car loans, home equity loans, and mortgages weren't handled through traditional banks. They may be originated by banks in some cases, but typically those institutions that originated the mortgages didn't hold the mortgages. They were bundled up and securitized and sold off as bond debt around the world. That market's still very, very broken, and that represented anywhere from 40 to 50% of the lending in the country over the last few years. So there's a big hole. I think the fallacy is that the Congress and the public feels like banks aren't lending. I think banks are lending, but that other lending activity that was going on in the economy has kind of dried up. And I will say banks have also tightened their lending standards. In addition to that, demand for loans among creditworthy people has fallen. Many people who have money just want to pay off debt and ride this thing out. So the credit contraction is not just a matter of banks not lending money, it's a matter of demand falling and the securitization market having kind of been obliterated. So if you have a recession and a credit contraction, that goes back to that deflation argument. Those are inherently deflationary events. I mentioned Americans have lost about $20 trillion in net worth since October of 2007. It's deflationary. We talked in the 90s, in the early part of this decade, about a wealth effect where people feel rich because they have a lot of home equity, or their 401ks were worth a lot, or they invested in a .com in the 90s that went up, and even if their income hadn't changed, they felt wealthy and they spent a lot of money. So there was a positive wealth effect, and now we're getting kind of the negative of that. But Obama to the rescue. The Obama administration's not really, I would say that he hasn't really changed the policies of President Bush. He's kind of put them on steroids. So if President Bush wanted to spend $700 billion on a bailout, he's going to double it. He's doubling down. The new PPIP program, as I mentioned, I would call it it's more of a mulligan of the TARP. It's a do-over. We're going to try TARP again. This time give it a new name. Now, a lot of people are rightly worried that with all this increase in federal spending, the federal deficit is going to triple in the next year and a half. The total debt is going to approach levels we haven't seen since World War II. That's when we were fighting for our literal survival as a country. So yes, there's a lot of concern about all this federal debt. And I think about federal intervention. There's a lot of concern about the President of the United States just offhand firing the President of General Motors. That's typically been a matter for the board of directors and the owners of the company to make those decisions. Now the President of the United States is. So that's concerning. And the other concern there is with all this federal creation of money is we're going to set off a wave of inflation, the likes of which we may have never seen. And at best, we haven't seen since the 70s. So now this sets up that tug of war. So let's look at the evidence for deflation and inflation. The deflationary evidence is that interest rates have remained low. The Fed's committed to a policy called quantitative easing, which means they've done all they can with lowering interest rates. They're zero. Quantitative easing says they're going to go out and be active participants in the market and buy long bonds to force interest rates down. They just did some more today, so they've now spent about $36 billion. They've committed to $300 billion. There are estimates that say they kind of have in their mind maybe $700 billion worth of debt. The last thing the Fed wants is for long-term rates to start running up, forcing people who have adjustable rate mortgages and poor credit who can't refinance to go into default and set off even more defaults. So they're trying everything they can to stimulate the economy through low interest rates. There's a lot of concern about a treasury bubble. It's interesting because Dr. Anwar talked about those 5 books, and there may be a treasury bubble. I don't have any clients borrowing money to buy treasuries. Treasuries are the least owned asset class among household, among individual investors. They're insignificantly owned by U.S. investors. Something around 2% of household assets are in treasuries. So they are not a hot item. They're the most reviled asset class around, and yet people are talking about a bubble. Typically, bubbles imply that everybody wants some, and people are borrowing money. We're not seeing that in treasuries, so we think the bond market may be telling us something, that the deflationary pressures are going to hang out there for longer than most people feel. Now, what inflationary evidence do we have? Stocks have rallied 20% since the March bottom. Commodity prices are up. Oil prices are up about 30% from their bottom. And the increase in value in TIPS bonds, which are Treasury inflation-protected bonds, they're up about 15% since this group last met in October. So there's some evidence of people preparing for inflation, or markets preparing. So who's the winner, inflation or deflation? I think inflation. Clearly the Fed can't print money endlessly without creating inflation. And by the way, the Fed's been joined by every other central bank in the world, which is why the dollar's remained strong. It's the best house in a bad neighborhood. So in time, inflation will win out, but I think the key is time. How long do we push that out? And I think it may be longer than many investors expect. That's just my view. During the credit contraction that accompanied our Great Depression in the 30s, interest rates didn't bottom out until 1942, which was 13 years after the stock market crash. In the Japanese lost decade, which is really more of a lost decade and a half now, because their credit contraction started in the early 90s. interest rates haven't been on Japanese government bonds, on long bonds, haven't been over 3.5% since 1993. And they've tripled their national debt. So I don't suggest that we're going to see that type of long-range deflationary pressures, but maybe a year or two longer than a longer time than people think. And we'll watch the data for that. So last October, I said I expected the government to intervene more than they have in the past. Well, I was right on that. I also thought people might postpone retirement and frugality would become cool. And we see all kinds of stories in the media about people postponing retirement, baby boomers who plan to retire a couple of years ago are continuing to work, which is causing a lot of stress among college graduates. That's not a good trend for you seniors out there. But we also see a lot of media evidence of frugality getting to be the cool, hip thing to do. I also thought there'd be a lot of banking sector consolidation, and there's been some. Probably not enough. And the government seems to be putting more roadblocks in the way of consolidation in the banking sector rather than encouraging it. I talked about the savings rate being key to bringing the next great growth phase. And that's really exceeded my expectations. We're seeing that the personal savings rate in America has gone up to over 5.7%. This is from negative in 2007. And it took 25 years for the personal savings rate to go from 8% down to negative prior to this collapse. So people are saving money. I'm sure our banking colleagues can say, yeah, deposits have swelled. That's a really good sign, but keep in mind that while that savings rate rises, and we think it might reach 7% by the end of the year, while that happens, it's a huge drag on the economy. Because for every dollar people save, it's a dollar they're not spending. It's a dollar that's not going to some restaurant or retailer here in the local economy. The recession has become global. We talked about that last time. I talked about Europe. So now we have these global imbalances, and Mohammed Al-Arian talks about it a lot in the book that Dr. Anwar mentioned. We may be in a situation where China is our biggest lender to the United States. They have expressed some concern about the printing of money and the devaluation of the dollar. So we may have a situation where the Chinese start buying assets instead. I can envision a scenario where some protectionist trade union manufacturing company in the United States ends up being bought by a Chinese-owned company. So just look for things like that out in the future. Corporate balance sheets and compensations will get more appropriate and transparent. This would have happened without congressional hearings, but those hearings make such great theater. Aren't you glad you get to see that every once in a while? I would implore investors to revisit the basics. One is diversification, and diversification is it's not a function of how many securities you own. It's a matter of the correlation between those asset classes that you own. I'm sure Dr. Owen can go into much more detail. I would encourage people to take longer time horizons and think about matching the time horizon of the typical returns on a particular asset or asset class to what their time horizon is. And remember the compounding of dividends. It's hugely important in total stock market return. It's not just the price of the security, it's compounding of dividends. It surprises people to know that since 1971, when the NASDAQ was created, the S&P Utilities Index has handily beaten the NASDAQ in total return. And that's because of dividends. The NASDAQ typically has very low dividends. Utilities tend to pay 3 to 5%. Those matter. Finally, I want to say this recession will end. They all have. Our economy, I think, will recover early next year. That probably places a stock market recovery sometime in the back half of this year. I'm not sure that what we're seeing right now is the bottom, or what we saw in March was the bottom. I'd love to be wrong on that, by the way, but we're still taking a cautious stance. I think when you look at what happens in recessions is they wring out excesses. Excesses in pay, excesses in lifestyle, excesses in debt. And that's just happening. It's the natural course of things. I would say that people should not give up hope. The next 20 years, I think, are going to be much better than the last 20. Technology is going to advance. We talked about that at the last meeting. There's tremendous opportunity in biotechnology. We're going to see all this government money spent on green energy, most of which will probably be frittered away, but they may have a few real home runs out of that. So I think the long-term investors should take the opportunity to say valuations are coming in. We've had deflation of assets, and guess what comes after that? Inflation. We have very, very rarely had a 10-year or 12-year negative return on the Standard & Poor's 500. And if you look historically, sometimes those can persist a little longer. They try your patience. But if you look 10 and 20 years out, they're tremendous. So for the young people here, if you have Roth IRAs, if you have something that's a long-term vehicle, think about the fabulous returns that could be out there in stocks if history even rhymes. It doesn't have to repeat itself. So with that, I'll turn it over to Pat.
Our next speaker, Mr. Pat Ware, Vice President, Amarillo National Bank.
I don't mean to correct him, but I'm only an assistant vice president. I don't have that much power. And I thank Professor Anwar for putting me in between the two smart speakers. Y'all can go ahead and take a Coke break or whatever y'all want. Listen to these guys. Don't listen to what I have to say. But I think the reason they have me here is they want me to give kind of an outlook on how we see the global financial crisis affecting Amarillo. So I'm going to talk today about Amarillo's economy and then also banking in our area. And just like we started seeing last year in our index of leading indicators that we put out, it started going negative. And usually that's about 4 months ahead of what we see. So what that means is 4 months from then, we thought the economy would start going bad. And sure enough, in January this year, our economic pulse started showing negative numbers. And also, like we said last fall, we don't believe this downturn in Amarillo's economy is going to be as severe as the rest of the country. Now, but the main thing is, and this is the question on everybody's thing, we have to wait and see how long it lasts. Amarillo's economy is pretty complex, and what we try to do with our polls is we put it out every month, and we try to put out information on different segments of the economy that people understand and can relate to. When people think about the economy, the first things they think about are employment, housing, and overall price levels, which is pretty much inflation. And the most important number we look at is jobs. Employment numbers are important because they're directly correlated with the quality of life for individuals and also a functioning economy that increases overall output. And like I said, beginning at the start of this year, Amarillo started to see a decline in the number of people employed. In our March economic pulse, we were down 1,200 jobs from last March, with the losses coming in transportation, utilities, manufacturing, and business service sectors. We think the job losses can be blamed on the nationwide recession and the collapse of commodity prices, especially energy prices. Construction and housing in Amarillo is also down. Big projects at the start of the year from Bell Helicopter and Amarillo College kind of artificially boosted the numbers, so now we're starting to see more real numbers. And building permits in March were down 54% from last year, and residential starts were down 44%. Also in the housing sector, we've seen prices decline about 3%, while overall the actual number of homes sold is down 7%. And while those numbers are down, it's nowhere near as bad as they're seen in California, Phoenix, and Michigan. Retail sales are down, and that's pretty alarming for us because that's the first time we've seen that in quite some time. We think this is due to both the loss of jobs, but also people acting in their best interest and spending less money. This is where uncertainty and consumer confidence really impacts our numbers. The thing on a lot of people's minds is inflation. We put out a CPI report that's pretty much just focused on Amarillo, and the inflation numbers are down, but in the future we're looking to see a run-up. Our CPI is showing grocery prices are up, but we also think people are buying more generic and private label foods instead of consumer staples. And like Bob was saying, all this government spending is bound to stoke some inflation, and we think that's evident in the term structure of the yield curve right now. It's getting pretty steep. Commodity prices have a big impact on our area, and we did see a big run-up in commodities as speculators and hedge funds piggybacked on each other's trades and drove up prices. But during the great leverage unwinding last fall, we saw how much these players contributed to the rise up in prices. If it were wholly a demand-driven issue, the decline would have been much less steep and severe. And this is going to directly impact farmers in our area, as well as the drought that we all notice. So the farmers are going to struggle this year due to the lack of spring moisture that has put us behind other ag-producing parts of the country. Other industries important to our area are dairies and feed yards, and both those are struggling. The dairies, most recent milk checks coming into dairies are at $10 or below for every 100 pounds of milk a dairy produces. And going out in December, it doesn't look like that number will get above $15. And this makes it hard on dairies until December because their break-even prices are between $15.5 and $16. Dairies that aren't hedged to both lock in the selling price of their milk as well as to lock in the purchasing price of their inputs are losing between $2 and $5 per cow per day. Feed yards are having the worst time in over 30 years, and some people are saying this is the worst feed yards I've ever seen. There's excess feeding capacity along with the worst losses on cattle that, like I said, we have ever seen. It began with a huge spike in grain prices that, as mentioned, was run up by the speculators, and not so much as the ethanol demand is. This was followed by a dramatic drop in cattle prices that shadowed the drop of all commodity prices. So here you had these feed yards with these high-priced cattle in the feed yards, and those prices dropped, and a lot of this cattle was unhedged. And then they went out a long ways thinking grain prices were going to continue their run up, so they had forward contracts locking in their prices at these high prices. So the cattle prices fell and the grain prices fell, and they're stuck. We think that supply side is okay for the cattle, but the demand worldwide is down. And now that since that wasn't such a rosy picture, we're going to change subjects and talk about area banks. And it seems like these days the only banks who are getting good press are the blood banks, the food banks, and the sperm banks. But we don't want to say anything bad about our profession, so we're only going to talk about local banks. And another thing that's important is in the 1980s, Texas had a huge banking crisis that contributed to a very severe recession in Texas. And what it was is all these other banks around the country were sitting around laughing at banks in Texas. Well, now Texas banks are strong, and these other banks around the country are in some serious problems, and so the question is, who's laughing now? Our area banks are okay due to conservative lending and knowing their customers and not extending out of the area. Banks around here are going to be impacted by the recession, but I don't think we're going to see any failures. One instance in proving how local banks are strong, and you hate talking or saying good things about the competition, is last month Herring Bank went up to Colorado Springs and bought a good bank in Colorado on the cheap. And what this shows is that the bankers around here make worthwhile decisions. They don't go out and raise expensive capital, and they don't take government bailouts. They patiently sit there, figure out what's best for their bank, and they go and act on it. And now it's time to toot Amarillo National's own horn. Amarillo National is a family-owned bank that is as far away from Wall Street as you can possibly get. We employ over 600 people in 10 branches and 3 drive-up Amarillo facilities in downtown and a full-service branch in Borger. We value our customers and employees much more than our shareholders, and this gives us a tremendous flexibility and competitive advantage. Not only do we help Amarillo by paying taxes, but we're also involved in downtown development, middle school education, youth sports, and some people in our family who work at the bank seem to put more emphasis on landscaping than banking, which at the end of the day is probably better for Amarillo. We've been serving customers for over 117 years and have 3 generations of owners working at the bank. The bank gives over $1 million a year to local charities. And the main topic is bank strength and how their balance sheet look. And as compared to last year, our deposits are up 6%, our loans are up 7%, and our capital is up 12%. Our installment loan past dues are down 30%, and our mortgage past dues are flat. One of the things I like coming to WT and talking to these students, because I remember taking some finance classes and I loved them, so I try to take what I learned in my finance classes and apply it to the bank. And I think our story is a good case study in decision making in finance and also capital structure. We're 100% owned by our family and do not have short-term outlook like publicly held banks. Their entire focus is on next quarter earnings just because there's so much emphasis on what the Wall Street analysts say. Our entire focus is making sure the bank will be around for our grandchildren. This allows us to make better decisions and takes out the problems that some of your teachers would call asymmetric information. And the 2 types of asymmetric information I'm talking about are adverse selection and a moral hazard. And the adverse selection happens before an event, in this case an EPS earnings announcement. And what happens, what we think happens is to hit or exceed their expected EPS, these banks they'll go to their accountants and try to do some accounting tricks to inflate some earnings. And then what happens is their peer banks will also see that they're doing this, so they'll try to do that. So that increases their earnings, and Wall Street loves that, but that artificially inflates their stock price. And then at the end of the day, somebody will blow the whistle, say that those earnings aren't quite so strong, and then the stock prices of the banks will fall to or below book values to revert to the mean. The moral hazard part of the problem is what happens after the EPS announcement. And what that is these guys on Wall Street, they'll see their banks hit their earnings and they'll do everything they can to make sure they hit their earnings. So what they'll do is they'll put on too much leverage on their balance sheet, take risks that they're not used to taking, start selling CDOs or get into some commercial real estate lending. The moral hazard leads to risk taking that is not truly in the interest of the shareholders and leads to disaster. While the business of lending always has asymmetric information, our decisions are based on strong credit backgrounds and long memories. Worrying about pleasing your shareholders is much more consequential because it forces management to have a much narrower outlook. And also on finance, you talk a lot about the capital structure. And I think the capital structure lesson we see in banking is that retained earnings are by far and away the best way to finance operations. Because instead of raising expensive bonds and equity, this is the cheap way to do it. It keeps your cost of capital low. And at the bank, we like to say that your bondholders are like parents who don't let you do anything, and equity holders are like teenage kids just wanting money out for no good reason at all. Since strong and growing bank capital is more and more important to customers, we can plow all our earnings directly into capital instead of those other banks who have to pay their bondholders and give dividends to the equity holders. There are contractual obligations to the bondholders, and stockholders know that bank stock is not worth having unless dividends are paid out. Lenders restrict growth possibilities and might strangle management, and sooner or later, equity holders are going to demand bigger dividends or eventually an all-out sale. So not having to worry about the demands mean you can concentrate wholly on the operations of your bank, your employees, and your customers. And that's what we're seeing in Amarillo with the banks here, why they're stronger, why things are going to be okay. The recession's going to stay in Amarillo, not as long as we think. It has hit Amarillo is what I'm saying, but the strength of the banks and the quality of the people around here is what's going to carry us out of here. So in closing, the Amarillo economy has slowed down, and we don't know how long it'll last, but we do know that it won't be as painful as other parts of the country. Area banks are strong and don't have to answer to the government, which is very important. And the last time I was here, I think I closed out with kind of a quote that came off as pretty cocky. It sounded cocky, so I said, we're better than Wall Street. And I want to correct that and say, we take better care of our customers and business than those on Wall Street. Thanks.
Our final speaker, Professor Jim Owens.
Well, thank you all for coming, and yes, what they said. I've got to talk to Anwar about what I did to make him mad enough to make me always go last. We've got to rearrange this somehow. Well, let me raise a couple of other issues with you. One issue is that we expect in the banking sector, U.S. banking sector, that there's probably about $3.1 trillion in what are called toxic assets. That is assets, paper that is not worth the underlying support. We've acknowledged so far about 1.3 trillion. So we have a ways to go. Now, we have probably absorbed already most of the subprime mortgages. That's pretty much done. What is happening now are commercial loans, credit cards, all the things that happen in a recession, normal mortgages, are beginning to show weakness. So these are good, solid borrowers. These are not the ones that people heinously like to refer to as the subprime. And it's one of those issues that you need to kind of think a little bit about, in the sense that this is not new. We do this frequently. I mean, every 10, 15 years, we have to have a crisis. Now, one of the things that happens in a crisis is obviously some people get severely hurt, and the losses we've seen in paper assets have been pretty severe, but it's also how we learn. How do you learn what works and doesn't work if you don't try? As a young man, I used to be very deeply involved in motorcycle racing, and we always used to laugh, you don't know how fast you can go until you fall off. Well, that's pretty much what's been happening. We tried some things for a variety of reasons. They failed. There are two reasons, without getting too philosophical about it. One is what they call confirmation bias. Confirmation bias means that when you look for facts, You only look for the ones that support your predetermined position. You're not really looking for facts. You're looking for a specific set of facts. So what happened was, as all this expansion took hold, literally from 1997 through 2006, housing prices nationwide in the U.S. went up 124%. That's more than double. Now, it's not in Amarillo. We have not gone up 124% between 97 and 2006. There's a very good reason. Any of you who stepped outside the door last Saturday know the reason. You don't come here unless you're coerced. Truly. You got to have family or job, and then after you're here for a while, you say, this is okay. You stay indoors on Saturday. And you say, my God, there went the field. And I wonder where it'll land. But what I'm saying is we never saw the run-up of 124%, so we didn't see the declines. You know, that's a good thing on the downside. Of course, on the upside, all of us were kind of upset. We're all looking around saying, geez, I wish we had some facts that would confirm the fact that the California people were smart. The next bias is what they call superiority bias, and that is you always think you're smarter than the other guy. Now, last year when we spoke, I referred to it as numerical tyranny, and what I mean by that is people who can flip statistics around better than you can typically scare the hell out of you. You don't want to look stupid by going, what was that in real words? Because they're saying, you know, they are squared, and the subsumption of this, if you take the square root of that, you were going, oh, okay, yeah, right. That's superiority bias. Right? And we had a lot of that going on. Many of the securitization products were developed by people who are PhDs out of MIT et al., who have never, ever made a loan, bought a house, run a business. They're mathematicians. If the formula works, the formula works. And I'm not going to tell him it doesn't work because he has a PhD in math from MIT, and I don't. And I'm looking at it going, okay, that's got to work. I mean, my God, look at the math on that thing. And it turned out it didn't. To give you some numbers relative to what Pat said about Amarillo down 3%. Last 2 years, Miami's down 38.9. Phoenix is down 31%. These are 2-year numbers. Vegas is down 48%. They have fallen from a median price of $288 to $150. San Diego, which came late to the party, is already down 35% and trying to take the lead. San Francisco didn't get in on the game until about a year ago. It's dropped over 35% in 1 year. Not 2 years, 1 year. If you put 20% down in 2006, you are underwater. You're not a subprime borrower. You're not some slime ball, no doc, low doc. You put 20% down, you had a job, and you are now have a mortgage that is 20% higher than the value of your house. It's awfully tempting to say, I could live in this same house for 20% less by picking up my couch and going across the street. And that's what we're seeing. The only way out of this is you have to work the inventory off. Now, we have very low mortgage rates. We have seen a vast amount of refinancing. Actually, new home sales are starting to come up a little bit. Why? Because the rates went down, and some people are figuring, this is pretty cheap. If I get into Las Vegas at half of what it cost me 2 years ago, and I want to be there, this might be the time. But it will take a while to work all of that off. There's a large overhang of that unsold property out there that has to work itself off. That gets us into the world of how did we get into the mess AIG at all. What we did with the subprime loans is we packaged them up and we securitized them. We've been securitizing for years. All right? Mortgage-backed securities are very familiar. Believe me, any of you who own a home, you would not own it if we did not have mortgage-backed securities. Guarantee it. In the old days, when all we had was the S&Ls, you had to wait till everybody paid off before there was enough cash to make the next loan. They only loaned at the rate at which they collected. So you got on the list, and you waited your turn. Now we go down and say, I have A1 credit. You know, I'm sitting around a 780 and 800. I got good numbers. I want to buy this house. Here's my 20%. And we fully expect, okay, here's your mortgage. You can't have that without securitization. You've got to be able to convert the mortgages you hold into cash to make new ones. And we've done it for years. What happened was, with the subprime, we started packaging them up and putting them into the market, not really comprehending just how risky they were. The people who bought the securities, they're saying, well, it's a mortgage-backed security. I've bought those before. And besides, it's backed by some kind of a credit default swap, typically issued by AIG. Now, a credit default swap is a simple-minded instrument for those of you who have ever looked at options. It is a naked put. That is, a put is the right for you to sell something back to somebody at a specified price. If I sell you that right, and for a premium, I have written a naked put. I don't own the underlying asset. I've just said, I think the price will go up, not down. You'll never exercise it, I'm going to keep the premium. What AIG did with the credit default swaps is they sold over $400 million worth of those. And they had huge fee-based income. Now you say, now why would you do that? Well, because remember, from 1997 to 2006, house prices went up 124%. Even if I take back the house, I can sell it for a higher price. Nobody saw house prices collapsing the way they did beginning in 06, 07. It's why we are now still already 18 months into a recession, and it's likely to continue. But most of those subprimes are out of the game now. What we're now concerned with is how deep will it get in terms of the recession on normal mortgages, normal commercial loans, and credit cards. Granted, people are beginning to pay off at the consumer level, but at the corporate level, we've got to keep those flows of funds working. You can't do business without financing. You just can't. Cash only won't work. You are then limited solely to your internally generated funds. So basically what happens is, in a situation like this, to work our way out of it is not going to be easy, it's not going to be fast, because it's underlying things that have to work out. I.e., we've got to get the housing market stable, which means we've got to start buying up that excess. We've got to get enough people back into the market, buying homes, at least the prices flatten out, and hopefully start going back up a little bit. That then creates that feeling, okay, I've got a little money, and things are getting better. Maybe I could go ahead and pay for something. Maybe I could go ahead and buy a few things. And we start slowly stimulating the economy. I did read a piece last night, and then I'll conclude. In Germany, they are paying you in euros, but the equivalent of $4,000 if you'll dump your 8-year-old car off at the junkyard and go buy a new one. That is being bandied about for the U.S. The number is $8,000 that I'm seeing. We'll pay you $8,000 to take your clunker as a voucher if you drop it off and let them crush it, and then go buy something new as a way to artificially stimulate the auto industry. And you got to think that one through. There are a lot of interesting issues in there. Number one, if you are a collector car enthusiast, as I happen to be, that pretty much put the end to your world. Because you don't know right now which are the current 8-year-old cars are going to become collector cars until 25 years from now, and by that point they're all about that thick. Which is going to be really tough to do a restoration on. It's going to take a while. The other issue is, it's just in effect government largesse through the back door. In effect, we're paying the people to go buy cars. We could just as easily give the money other than the fact you wouldn't have production. But more critically, what do you do to all the mechanics that are keeping all those old cars running? And what do you do to all the parts houses that sell the parts to keep all those old cars running? What I'm saying is, we come up with a lot of these short-term solutions. As you think them through, think about the ripple effects globally. And you start saying, well, maybe that's not the answer. Maybe we get out of this one like we always get out of it. We suffer for a while, and we slowly crawl our way out, and 5 years from now we look back and say, okay, which of that era, what pieces do we hang on to, and what do we promise never to go do again? Because that's how we learn, that's how we make progress. I don't know how else to do it. None of us have the superior saying, well, here's the next invention. We invent by trying things out. Who among you can say every single new idea, 100% of the time, should always work? Answer, nobody. We say if you can bat 50% plus one, you're winning. Well, why is it different in finance? And the answer is it's not. It's a painful way to do it. Probably not the most logically efficient way to do it. I don't know another one that is even remotely free market. So my message to most of the young people, hang on, it's going to be a little bit of a rocky ride for a while. We're going to come out of this. Remember the books. I'll tell you, 15, 20 years from now, we're going to do it again. I just don't know what it will look like. But we will be back. It is just the nature of the animal. One other book, in addition to the one that Anwar mentioned, there is a book that was written in the 1800s by Frederick Macklin called Extraordinary Popular Delusions and the Madness of Crowds. And it's all about the South Sea Bubble and the tulip craze. Read it and think about the housing craze up through 2006. And then just substitute the word tulip for house. And you got to go, you know, we've been here before. It just is the way in which we behave. You know, and I don't know that there's a better way. I wish I could say that all this pain was unnecessary. I'm not sure it is. Maybe that's how we make progress in our kind of economy. People in more structured economies make progress in other ways, but this is how ours works. I will turn it over to you. Can ask them questions. They're the smart guys.
Okay, we have 20 minutes for your questions and answers. Pradeep?
My question to Mr. Juba. Would it be fair to say that this crisis has been a public relations disaster for the financial services industry?
Yes.
The reason I'm asking you this is we had a discussion on ethics and social responsibility in my MBA class. And one of the questions that came up is, when was the last time you walked into your financial services office or advisor with the feeling of complete confidence and without a feeling that they're going to rip you off? And not a single hand went up. And the median age there was above 40. So my question is, how does the industry plan to get out of this crisis of confidence as much as crisis of cash or crisis of other proportions?
Well, the short answer was yes, it's been a crisis of confidence and a PR nightmare. I think you put up numbers and you start to see progress being made in banks across the country. It looks like, and I'm not speaking on behalf of Bank of America, but most of the big banks have indicated the first quarter that they're going to make a profit. So you start to make a profit again. You start getting back to the core of your business. The community banks have done that. They've done a good job. Community banks, even large community banks, aren't big enough to bank the DuPonts and the GEs and the major Fortune 500 companies that we need in a global environment. So we're always going to have money center banks. And I think they're going to get back more to the core of what they do. As Dr. Owen mentioned on credit default swaps, it was like an insurance policy with no reserves. And that's why they're paying for that. But over time, those headlines abate. We get back to doing what we do in our business, which, by the way, I don't think really had anything to do with the crisis. We try to take care of our clients and see to their needs, and we just do it one client at a time. There's no other way to do it. If there was a silver bullet, I'd have long ago tried to use that, but there's not. It just takes time.
you to convince me this is not going to last until 2014. The reason I'm saying that is liquidity. Our credit cards are 38%. 38% of our total debt. We've given lip service to it and said, well, yes, these enormous penalties and enormous interest, we're going to do something about it. In 2010, Congress said that. If you give a stimulus package, if it goes to credit cards to pay off the debt, that's not an immediate stimulation. So my question is, when will the liquidity come back to the United States? Those that have money, I'm not going to buy this car now. I'm going to wait 3 or 4 more months, and General Motors is going to have a half price sale. So tell me about liquidity.
There's no way to guarantee it won't last that long. Now, we're already in the longest recession since World War II. Even the Great Depression, which was much more catastrophic than this in terms of unemployment, in terms of foreclosures, in terms of bank failures, didn't last that long, because you're talking about a recession that would have by then lasted 6 years. So I think the odds are we will see waves of improvement, but it's not going to, when the economy comes back, I don't think we're going to see a resumption of the type of liquidity that got us out of the last recession in 2002, when we saw people discover the joy of home equity loans and taking capital out of their house to pay for vacations and consumables. That's not going to return. It's going to be a more modest growth ascent up. But you do have a lot of slack demand. Last year was the first year since World War II, and that was because of the war, that there were fewer cars on the road. So car sales dropped so dramatically that there were actually fewer cars on the road in the United States. Population continued to grow. The number of drivers continued to increase. So you do create over time, before 2014, I think you'll see demand increasing just because of pent-up demand. Cars wreck, cars rust out, cars break down. That's one indicator. As Dr. Owen mentioned, you're already seeing some uptick in housing because people feel like, wow, I get a value. Credit card debt is, you can look at defaults, and it's very, very tightly correlated to unemployment. So if unemployment gets up to 10%, which most of the credit card issuers have already factored in a higher unemployment level than that in terms of their reserves. So I think they're in pretty decent shape on on loss reserves for credit cards. I don't think that's going to be the other shoe dropping. If I'm looking at it and if I'm trying to predict what the catalytic event to kind of mark the end of this would be, when the Europeans face their banking demons. And I think it'll be before 2014.
I have a question for Pat. I'd like for you to address that through all of this, it may have been addressed, but I've never heard it addressed, is everyone talks about the low interest rates, good for the economy, good for the house and everything, but you have a lot of elderly people in your bank and have in a long time. A lot of these people have been drawing 10, 8, 6, 5, 4, now they're getting 1% on their CDs. A lot of those people put all of that money in the economy. They spent all of their interest. That was like free money to them. They spent a lot of that interest, and I know that has to be a factor in the economy, because I know all those people that had money that were spending it when they were making 8%. Now they're making 1%. They're not spending the 1% because they're scared now. And I watch CNN a lot. I see a lot of things. I've never heard that addressed by anybody, how much income has come out of the economy by the interest rates going down too. And it may not be a factor, I question.
Well, no, that's a good question, and I couldn't tell you how much of people's spending comes from the fixed income individuals, but I know at the bank we're getting a ton of phone calls by the older people complaining about the savings rate, and the only thing I can tell them is this is the Federal Reserve truly bailing out these Wall Street firms, taking the interest rate so low to where they're encouraging people to spend instead of to save. And that encourages the younger people to spend, hopefully, but it destroys the people living on fixed income. So, I think that's just a decision the Federal Reserve made at the detriment of the elderly living on fixed income.
So do you see that going up? What do you see a time frame on interest rates?
As soon as
For
inflation
investors,
starts
not-
rearing its ugly head, which it's bound to do with all this spending, interest rates are bound to go up. And as the economy improves and inflation comes, the Federal Reserve will act quickly.
18 months, 12 months?
I'm not going to get into forecasting. I do think, like Juba said, by next year we'll start seeing improvements in the economy, and I do not know though if the Federal Reserve will act on that, or if they're going to keep these rates artificially low.
Other questions? Yes.
I have a question about global economic situation. According to recent economic data, global economic data, for example, like GDP of G20 countries, if we take a look at this data, we will see that all developed countries have a pretty weak or negative growth, but developing countries still have a strong GDP growth. And the question, especially India and China. And the question is, in your opinion, how do you think what we will see in 20 years? These countries, especially India and China, they come up with developed countries, or we will see a new economic leader?
I would argue against a new economic leader simply because you are talking about two of the most heavily populated countries in the world. Their problem is avoiding political catastrophe. When you have two countries with over 1 billion population apiece, you are so focused on keeping your own people fed, housed, happy, improving their lot in life. You really don't have time to be playing big dog out in the world markets. China has got about 15 years to pull that economy together, or they are going to have a revolution, which means massive expenditures on just simple everyday things you and I would take for granted over here. Because those people, as communication improves, they know those opportunities are out there. They know that life expectancy ought to be in the mid-70s. They know that you shouldn't have an infant mortality rate as high as they have. They want those things. And they're going to have them, and they're going to pressure the government. The government is going to spend every dime it's got, basically, to protect itself, to protect its own country. I don't see them going after them. In fact, I would be amazed if China doesn't wind up buying more U.S. treasuries. Simply because it's the best, safest return they can get to keep that pool of money working. And they've got to keep it working. The reason also the developing countries, number one, they did have a bit of a decline. You got to recognize most of them are commodity-based. A commodity-based economy, when you have a global recession, is going to hurt. Texas is hurt. Not as bad as a lot of places because we didn't have the housing thing, but we're a commodity-based economy. We suck it out from or grow it on top of. It's a pretty simple-minded place. Look at the funding you're seeing for the universities. When the oil revenue drops, boy, it gets tough around here. We are a commodity-based economy just like a lot of those developing countries. They went down. They will come back. You've got to be very careful with your statistics there. You got to remember, coming off the law of small numbers, a small dollar amount is a big percentage change. You'll see some of these countries all say, well, yeah, 20% growth. Well, yeah, but you came off a base about the size of Rhode Island, economically. You've got to deal in absolute dollar amounts, not in percentages, or you can't compare across. But I am not optimistic that we're going to see new world powers. I think they're going to be very, very busy the next few years, just hanging on to what they got.
I'd just like to add one quick comment on that, and I'd commend, I can't remember the name of the book, but it's by George Friedman, and it talks about the next 100 years. He's a geopolitical analyst and has CIA background. But his basic contention is, if you look at world trade, it's who controls world trade. And it's always been centered on the North Atlantic. We still look at the Baltic Dry Index today as a measure of world trade. And for 500 years, whoever controlled that, first Spain, then England, then the United States, whoever controlled the North Atlantic by sea would be the dominant power. His contention is now it's the Pacific and the North Atlantic. And there's only one player out there that has a navy that can control those seas. And it's not China, it's not India, it's the United States. So you look at it from more than just a brief moment in time GDP outlook and think longer term history. When China's opened up in the past, their coast flourishes, the social tensions rise between the hinterland and the coast, and then they end up collapsing and looking inward. And that's just that's what's happened culturally. So I would agree with Dr. Owen.
Yes.
As we accrue debt at an alarming rate, I believe we're in excess of $36,000 per person in this room and our constituents across the country. What is preventing us from defaulting on our own dollar? And or at what point, it looks like in my lifetime, we eventually will default on it. How far ahead is that, not that day, but what sequence of events is going to cause us to default on our own dollar?
Number one, you can't default unless you run out of electricity, paper, and ink. You have the power to print, so you can't default by definition. You just print some more off, maybe worthless, but I can just print you some. Cut it up in a nice little size and send it to you. Say, here, there's your 10,000, go buy a loaf of bread. So the absolute default is not the issue. I think what you've got to look at is the level of federal debt relative to the GDP. And relative to other countries around the world, we are in great shape. Our debt relative to GDP actually is quite low compared to a lot of other countries, and particularly Europe when it finally faces the reality of what their banks have done to them. So one of the issues I think really in there is for people to move away from the absolute dollar amount and think of it relative to the size of our economy. And it is an enormous economy. So in many respects, while certainly I would not in any way belittle the amount of debt, and I think it will cause inflation, that part of it doesn't concern me. What concerns me is how we use it. The absolute amount's less concerning than the utilization. And that is if you pour it into bank capital, as we did initially under the TARP program, and they just sit on it, then it doesn't stimulate anything. It doesn't create the economy that would then pay itself back. You've got to find a way to create enough economic activity that we've got such a tax base we can begin to pay ourselves back. Otherwise, we just keep stacking it on top of each other. And that's where the concern is the utilization rather than the absolute amount.
The only thing I'd add, again, to concur with Dr. Owen, we're the only country in the world that lists as a debt a future obligation to pay pensioners and Social Security, the so-called trust fund. Paul Simpson from Mac Thornberry's office here, Mac has talked about the accounting fiction. There's a file cabinet full of these bonds that are supposedly where the General Fund of the United States is going to pay back Social Security when the baby boomers retire. But those bonds don't trade on the market, they don't affect interest rates, and they're never going to be paid. So our stated national debt is higher than anything comparable to Europe. Europe doesn't do that, Japan doesn't do that. Their demographics are so much more skewed to old age, pension, and benefits than ours are. I hate to say this, and if there's any, particularly, if there's any congressmen in the room, but the capacity of the federal government is still pretty significant to issue debt. Japan tripled their national debt between '93 and today. Interest rates are still low, and it's still a very strong credit, and their currency's strong. So there's not always a one-off situation there. We're overstating our debt because of Social Security. Our problem is the fact that we don't really have any reserves for Social Security. So taxes are going to go up, payroll taxes in particular. That's the real challenge that lies for us.
One more question. Yes, sir.
kind of going on to the same thing that Dr. Lynch asked earlier, but on the credit card debt, you know, we keep reading articles saying that the credit card debt's going to be the next subprime mortgage crisis. That's the next thing's going to happen. Basically, follow the same route. They gave out money to risky borrowers. They did the same thing with the securities. Basically had it backed by insurance. My question is, we've thrown billions of dollars at these different banks, Bank of America, and Wells Fargo, and Citibank, that are now the guys that own the credit card debt. But we really haven't seen anything done to help consumers get rid of that debt. As a matter of fact, now we have interest rates going up on good customers and closed accounts. They're obviously trying to keep it from happening. But they're not doing anything to help people pay off the debt. Do you think that's going to end up catching up with us, and that it's going to be our next crisis?
How many of you got credit cards? How many of you got an interest rate under 12%? You can afford a lot of losses when you're making 24 to 30%. That's the credit card game. If I can charge you 24%, I can eat a lot of loss. And I don't think the loss levels, unfortunately, in the United States, we are almost obsessively honest. As much as we can, we'll pay it back, and I think the levels will always stay under the amount they're earning. That's why they keep issuing them.
Let me kind of lead on to that now. If people are saddled with this debt and have to pay it off every month, of course they have less, they're out buying less.
That's right. They're buying less, and that's again where we're talking about the recession lasting in for another year and a half, 2 years, till we start seeing some of this stabilize. But I don't see the losses in credit cards as being another subprime mortgage problem.
There's no possible way that credit cards are going to surprise equity shareholders or debt holders. That news, that story's been out there. The one thing I would comment, coming from a publicly traded company that has received a lot of TARP money, and the perception is they're not doing anything for lenders. Well, maybe curtailing credit lines is doing something for the lenders. We now have an obligation to pay back the government. There's a perception that TARP money recipients just got money from the government, just free and clear. Well, we've paid $400 billion last quarter. We're going to pay $400 million last quarter, $713 million this quarter. So that's not free money to the banks. JP Morgan, same boat. All the other Citibank, everybody else who's gotten those monies are paying interest. And they have to raise rates commensurate with the risk. If people are walking away from their house and the credit score's dropping, they're going to have lower rates. People who don't use credit, I don't carry balance. I've had an American Express card for 25 years, and I just don't carry balance. To keep it free, I switched to one where you could carry balance. And I noticed my credit rating, which is good, thankfully, but they curtailed my credit limit by 15%. It's not a factor. I don't use it, but it's there. And they're all doing that because they've got to trim their exposure to that type of debt. And you can't have it both ways. You can't sit there and say you want the banks to be profitable and pay back the taxpayers, but you also want them to give forbearance to credit card customers, many of whom were profligate. So.
Okay, before we conclude, just want to make a few comments. As all the speakers correctly mentioned, in my opinion also, the next 12 months are going to be very, very busy. We academics, if you do research, when you do teaching, you'll be very busy collecting data, observing all the things. If you are a banker, you will be very busy. If you are an investment banker, you'll be busy. If you are an infrastructure company, look outside what's happening. Lots of roads, bridges, they need help. And you will see lots of activity. Are you going to see some problems in emerging markets, as some of you mentioned? And the answer is yes. Alex is from Russia, and Russia has a very big problem right now. So all these things, they will also bring us few opportunities, of course, and they will also help us understand how to deal with the issues, as our speakers correctly mentioned. So that's where we finish this very interesting topic, and hopefully, since I believe in longitudinal data, historical data, maybe we need to do this seminar after 2 years and see what went wrong, how did we deal with those issues. And so with these comments, we would like to thank you for coming and do appreciate all your help. And let's give a hand to our wonderful speakers.